Man Pictures presents the Forex video training series, Black Belt, First Degree, Trading the News. There are two main ways to trade the news, having a directional bias or having a non-directional bias. Having directional bias means that you expect the market to move a certain direction once the news report is released. When looking for a trade opportunity in a certain direction, it is good to know what it is about the news report that causes the market to move. Consensus versus actual. Several days or even weeks before a news report comes out, there are analysts that will come up with some kind of forecast on what numbers will be released. As we talked about in a previous lesson, this number will be different among various analysts, but in general there will be a common number that the majority of them agree on. This number is called consensus. When a news report is released, that number is given, it's called the actual number. Buy the rumors, sell on the news. This is a common phrase used in the Forex market because oftentimes it seems that when a news report is released, the movement doesn't match what the report would lead you to believe. For example, let's say that the U.S. unemployment rate is expected to increase. Imagine last month the unemployment rate was at 8.8%, and the consensus for the upcoming report is 9%. With a consensus at 9%, it means that all the big market players are anticipating a weaker U.S. economy, and as a result, a weaker dollar. So with this anticipation, big market players aren't going to wait until the report is actually released to start acting on taking a position. They will go ahead and start selling off their dollars for other currencies before the actual number is released. Now let's say the actual unemployment rate is released as expected. It reports 9%. As a retail trader, you see this and think, okay, this is bad news for the U.S., it's time to short the U.S. dollar. However, when you go to your trading platform and start selling the dollar, you see that the markets aren't exactly moving in the direction you thought. This is because the big players have already adjusted their positions way before the news report even came out, and may now be taking profits after the run-up to the news release event. Now let's revisit this example, but this time imagine the actual report released for an unemployment rate of 8%. The market players thought the unemployment rate would not raise to 9% because of the consensus, but instead the report showed the rate actually decreased, showing strength for the dollar. What you would see on your chart should be a huge dollar rally across the board because the big market players did not expect this to happen. Now that the reports are released, it says something totally different than what they had anticipated. They are all trying to adjust their positions as fast as possible. This would also happen if the actual report released an unemployment rate of 10%. The only difference would be instead of the dollar rallying, it would drop like a fucking rock. Since the market consensus was 9%, but the actual report showed a bigger 10% unemployment rate, the big players would sell off more of their dollars because the U.S. looks weaker now, and not what the forecasts were first released. Keeping track of the market consensus and the actual numbers, you can better gauge which news reports will actually cause the market to move and in what direction. Non-directional biased, a more common news trading strategy that is non-directional biased approach. This method disregards a directional bias and simply plays on the fact that big news release report will come and it will create a big move. It doesn't matter which way it moves, we just want to be there when it does. What this means is that once the market moves in either direction, you have a plan in place to enter that trade. You don't have any bias as to whether the price will go up or down, hence the name non-directional bias. Trading with directional bias. Pick a direction. Let's go back to our example of the U.S. unemployment rate report. Earlier, we gave examples of what could happen when a report came in light with expectation, or slightly better. Let's say that there was a surprising drop. What effect could this have on the U.S. dollar? One thing that could happen is the dollar falls. What? Isn't the dollar supposed to be rising if the unemployment rate is dropping? There could be a couple of reasons why the dollar could still fall, even though there are more people with jobs. The first reason could be that the long-term and overall trend of the U.S. economy is still in a downward spiral. Remember that there are several fundamental factors that play into an economy's strength or weakness. Although the unemployment rate dropped, it might not be a big enough catalyst for the big traders to start changing their perception of the dollar. The second reason could be the unemployment rate drop. Perhaps it's right after Thanksgiving holiday rush. During this time, many companies normally hire seasonal employees to keep up with the influx of Christmas shoppers. This increase in jobs may cause a short-term drop in the unemployment rate, but that's not all indicative for the long-term outlook of the U.S. economy. A better way to get a more accurate measure of the unemployment situation would be to look at the number from last year and compare it to this year. This would allow you to see if the job market actually improved or not. The important thing to remember is always take a step back and look at the overall picture before making any quick decisions. Now that you have that information in your head, it's time to see how we can trade the news with a directional bias. Let's stick to our unemployment rate example to keep it simple. First thing you would want to do before the report comes out is take a look at the trend of the unemployment rate to see if it has been increasing or decreasing. By looking at what is happening in the past, you can prepare yourself for what might happen in the future. Imagine that the unemployment rate has been steadily increasing. 6 months ago it was at 1%, and last month it topped out at 3%. Now you could say with some confidence jobs are decreasing and that there is a good possibility the unemployment rate will continue to rise. Since you are expecting the unemployment rate to rise, you can now start preparing to go short on the dollar. Particularly, you feel like going short on the dollar-yen. Just before the unemployment rate is about to be announced, you could look at the price movement of the euro-yen in the last 20 minutes prior and find the range of movement. Take note of the high and low that is made. This will become your breakout points. Note, the smaller range, the larger tendency there is for a volatile move. Since you have a bearish outlook on the dollar, you would pay particular attention to the lower breakout point of the range. You're expecting the dollar to drop, so a reasonable strategy would be to set an entry point a few pips below that level. Pick a side for a potential breakout. You can then set a stop just at the upper breakout point and set your limit for the same amount of points in the breakout range. Always have a stop and target in mind. One of two things could happen at this point. If the unemployment rate drops, then the dollar could rise. This would cause your US dollar Japanese yen to rise, and your trade would most likely not trigger. No harm, no foul. Or the news is as you expected, the unemployment rate rises, the dollar could drop, assuming the entire fundamental outlook on the dollar is already bearish. This is good for you because you've already set up a trade that was bearish on the dollar, and now all you have to do is watch your trade unfold. Target should be equal to the consolidation range. Later on, you'll see your target gets hit. You just grab yourself a handful of pips. The key to having a directional bias is you must truly understand the concepts behind the news report that you want to trade. If you don't understand what effect it could have on particular currencies, then you might get caught up in bad setups. Let the market decide which direction to take. The first thing to consider is which news reports to trade. Earlier in the lesson, we discussed the biggest moving news reports. Ideally, you would want to only trade those reports because there is a high profitability the market will make a big move after their release. The next thing you should do is take a look at the range at least 20 minutes before the actual news release. The high of that range will be your upper breakout point, and the low of the range will be your lower breakout point. Note that the smaller the range, the more likely it is that you see a big move from the news report. The breakout points will be your entry levels. This is where you want to set up your orders. Your stop should be placed approximately 20 pips below and above the opposite breakout points, and your initial target should be about the same range of the breakout levels. This is known as the straddle trade. You are looking to play both sides of the trades, whichever trade it moves. Now that you're prepared to enter the market in either direction, all you have to do is wait for the news to come out. Sometimes you may get triggered in one direction, only to find it gets stopped out because the price quickly reverses into the other direction. However, your other entry will get triggered, and if that trade wins, you should recoup your initial losses and come out with a profit. A best case scenario would be that only one of your trades gets triggered, and the price continues to move in your favor, so you don't incur any losses. Either way, if done correctly, you should still end up positive for the day. One thing that makes a non-directional biased approach attractive is that it eliminates any emotions. You just want to profit when the move happens. This allows you to take advantage of more trading opportunities because you'll be triggered either way. There are many more strategies for trading the news, but the concepts mentioned in this lesson should always be a part of your routine whenever you are working on an approach to taking advantage of news reports movements.